All right, everybody, we've got big news because David Tepper is boosting his stake in Chinese equities and ETFs. And he did so just before the developments surrounding the DeepSeek AI technology or app surfaced. So we have a lot to discuss today. And so without further ado, let's get started. All right, hi everybody. For those who don't know, David Tepper, he made a lot of headlines last quarter when he appeared on CNBC. So I'm not going to show the entire clip to you, but basically this is the title of the video if you want to look it up. It was released 4 months ago on CNBC. And I remember two things from that clip. One was that Tepper said, buy everything in China. And the other one was when he was asked about, well, is he possibly hedging his big bets on China? And he said, my hedge is that I don't care. Let me just show you the most important part from that clip again. So here you go.
Investing in China too. What's the risk? How do you?
I mean, that would be a risk, and that's why you have limits on how much you would invest. However,
you just said you don't have those
the other thing I thought you were going to ask is about tariffs and stuff like that. I do not care.
Yeah. Right. But you're a hedge fund. How do you hedge your risk? What's the counter bet that you put on that, just in case?
You know what? You know, I'm sitting here in a suit. My counter bet is that I don't care.
All right, there you have it. I think that moment is quite legendary already. All right, so David Tepper made headlines again yesterday because the 13F season has basically started, and David Tepper was one of the first to file his 13F. So the 13F of his hedge fund, the Appaloosa Management Hedge Fund, which as of today has around $6.5 billion in assets under management. And as we can see, if we look at this screenshot taken from Data Roma, for example, David Tepper is continuing to be bullish on China. He was increasing many of his positions. So Alibaba is still his largest position, and he increased that position by another 18% in the last quarter. In fact, Alibaba, or the shares of Alibaba owned by David Tepper, are now worth around $1 billion. And this makes David Tepper one of the largest shareholders of Alibaba in the world, which I think is quite mind-blowing. And if we look at the 13F again in his current portfolio, we can see that Alibaba isn't the only Chinese name in his stock portfolio. You know, there are other names such as Pinduoduo, which makes up around 8% of the portfolio. Again, he slightly increased that position. JD is another one. He actually increased that position by 43% in the last quarter, which now makes it a 5.6% position. Then he also owns two Chinese ETFs, namely the iShares China Large Cap ETF and the QWeb Internet ETF. You have another overview of the activity in Q4, the activity on the buy side. And with that being said, let's move on. So there are a couple of things that I want to address with regard to the decisions, the activity, or the decisions made by David Tepper and the activity revealed in his 13F. So first of all, I want to highlight a blog post that I released on my Substack not too long ago, 2 or 3 days ago, I think. Basically, I summarized a new Li Lu speech that appeared, I think, in November or December last year. I translated it and shared some of the key takeaways from that speech for investors. And the very first one was actually that Li Lu highlighted that you should, quote unquote, take the macro as it is. So just to quote him here, he wrote, or he said, our fundamental attitude is the macro environment is an objective reality. We can only accept it. The micro level is where we can actually do something. This is the basic stance of a value investor. The world is objective and will not change because of our wishes or subjective judgments. And later he said, value investing, no matter where it is practiced, is inevitably tied to its era. While in principle it emphasizes bottom-up analysis, the companies we invest in unavoidably operate within a specific period and I highlighted this, face macro influences. We cannot escape the time in which we live. Now, obviously, I agree with Li Lu here. I think as an investor, as a value investor, as an intelligent investor, it's important to be a bottom-up investor first, meaning you study businesses, you look at their financials, you study the management team, you come to an assessment with regard to the competitive advantages the businesses may or may not possess, and so on and so forth. That's what you start with. But then on top of that, you should be aware of what's going on in the macro world. That doesn't mean that the macro factors or the macro developments should necessarily lead to decision making on your part, but you should be aware of it and the impact on the businesses you own. And obviously, as someone who is investing in China, full transparency, I don't own any Chinese equities right now. I used to own Alibaba in the past and no longer do. But if you are interested in China or already own shares in Chinese equities, you have to be aware of what's going on in China. And the macro landscape in China seems to be shifting relatively quickly. The Chinese government is quite aggressive in terms of the stimulus or the stimulus packages they are releasing in order to support the economy, but also the broader stock market. I generated two summaries from ChatGPT here, just to highlight what exactly the stimulus packages include. So here we have one summary, basically the goal to continue to lower interest rates. Actually also included a screenshot here that shows the development of the China loan prime rate, for example, over time. And as you can see, we see a pretty steady decrease of the China loan prime rate. Then there were measures to stabilize the stock market, which obviously should also have an impact on stock prices. Like one part of that package or that measure, for example, would be that there are incentives for companies to buy back their own shares, which of course will stabilize stock prices, or should in theory stabilize stock prices, as there will be more demand for the underlying securities. And in 2025, China actually indicated that they are going to add a couple of new measures to that stimulus ambition. And you can see an overview of some of the measures right here. Now, with that being said, so the Chinese economy is struggling a little bit, and the Chinese government, the CCP, is doing everything they can to reaccelerate growth and stabilize it. And that is something you as an investor should be aware of. Speaking of macro awareness once again, if we now look at the micro level again, so the actual businesses you could be studying and the businesses that David Tepper owns, and take a look at the development of the share price of these securities, for example. As you can see here, pretty much all four of the individual securities that David Tepper owns, with the exception of Pinduoduo, they have done pretty terribly over the last 5 years. So JD only returned like 3%, and Baidu and Alibaba actually down over this 5-year time frame. Pinduoduo, on the other hand, has done quite well. It's up 232% over this time frame. Now, in terms of valuation, Chinese equities also appear to be quite cheap. I'm not going to do an in-depth analysis of the names here, but just looking at some of the headline numbers, we can see that all four stocks are trading at quite cheap forward multiples. So what you can see here are the forward price to earnings ratios, and all four names are trading below 15 times, actually below 13 times forward earnings. JD is even trading at a single-digit forward earnings multiple, which is definitely cheap, especially compared to US equities. And I think what I should also maybe stress here once again is that all four names I highlighted here, all four names from David Tepper's portfolio, those are truly dominant businesses in their area. So those are dominant internet-based businesses operating in China. And just to look at another valuation measure here, what you can see here is the free cash flow yield of all four stocks. And again, some of the stocks like Pinduoduo actually trading at double-digit free cash flow yield, Baidu as well, JD and Alibaba at high single-digit free cash flow yields. I think Alibaba's free cash flow margin is also fairly depressed more recently. So I think on a normalized basis, Alibaba is also trading at a higher free cash flow yield. So all four names seem to be optically cheap. However, if we look at the underlying businesses and how they develop, you also have to point out that Alibaba, JD, and Baidu, and here we're looking at top line growth, so revenue growth, haven't really grown at high rates more recently. So this chart here shows the development over the last 3 years. And I myself, as a past Alibaba shareholder, I know that Alibaba, over the period I owned the stock, hasn't really developed favorably. There were a lot of challenges the businesses had to work through, had to overcome, and this is also reflected in these rather disappointed growth numbers. Speaking of Alibaba specifically, for example, their core business, the e-commerce business, isn't really growing at all anymore, which of course, should give you concerns. But then again, you have to wonder, is that maybe already baked into the valuation of Alibaba? And also with regard to Alibaba, and it's also true for JD more recently, also wanted to include this chart here, which shows the development of the total number of shares outstanding for these companies. And Alibaba specifically has been pretty aggressively buying back its own stock, which, and again, is also contradicting the narrative that you don't actually own Chinese equities. No, as this chart here shows, at least Alibaba shareholders are getting a return, a direct return from the company, by the company actually allocating cash to share repurchases. So I'll just wrap it up here that I think if we take a look at the valuation multiples again, so the free cash flow yield being around double digits, so let's just say on average around 10%, that's like really cheap for public equities and especially for dominant public equities. And I think even if the businesses continue only growing at, say, a low single digit rate, investors could do well in these names over shorter time frames, simply because the multiple might re-rate. And there might be all sorts of reasons for the multiple to re-rate. Alibaba released quite recently news about their AI model they have been developing, which apparently is even superior to the DeepSeek model. So things like that could quickly shift the sentiment among investors. Then, of course, everything related to the Chinese economy in general, maybe tariffs of Donald Trump that may end up being lower than anticipated, stuff like that can really quickly lead to a re-rating of some names, I think at least. As I highlighted, David Tepper also owns 2 Chinese ETFs. So let me just show you the performance of these ETFs over the last couple of years. So this one here, for example, is the iShares China Large Cap ETF. As you can see, this ETF is pretty much flat over the last, 10, 15 years, which is, of course, an abysmal performance. And this one here is the Grain iShares Internet Index. Again, the performance ever since the 2021 peak has also been pretty terrible. Just to show you what names are included here, you have an overview of the top 10 holdings of the Grain Shares Internet Index. And maybe finally, one part or one interview from a CNBC clip that I wanted to show you that also highlights that generally as an investor, like you can't do well in investing and buy what's popular. And China is probably the definition of a stock market that is unpopular right now. So these guys, and I think they are the authors of the Big Short book, if I remember correctly, I might be mistaken here, but they, in this video clip, highlight exactly that they are looking off the beaten path. They are looking at Chinese equities, Brazilian equities, and so on and so forth. And they made a killing in 2024 and highlighted why. And they also briefly talked about Alibaba. So I wanted to show you that little sequence. And I encourage you to watch the rest of the video, maybe after watching this video.
If you look at the cheapest stocks in the world, you do screens, they all show up emerging markets, right? And we pitched, Brazil and Chinese stocks and came up and said, and everyone hates these Chinese stocks. Alibaba, which is AI, came out and said that their model is better than DeepSeek. And I didn't know what DeepSeek was before Saturday, and still don't. But you can win a lot of ways to win with the stock trading at 4.5 times earnings. That's cash, right? And the famous question we asked ourselves: what if it goes right? Right? Can it trade to 15 times? That's 3x our money, right? And so that's the type of thing we're looking at and we get excited about and saying, wow, this market's really cheap. Everyone talks about how expensive things are, but go to Brazil. You talk about, just the guest just had on, 10% dividend yields in the index, right? And so where can we make money that's where everyone else is not looking?
Okay, let me just stop here. And I agree with them. If you find a stock that is trading at 4 times earnings, that is a dominant business that is at least not going to shrink over time, well, you probably have a wow stock that you have found. I'm not sure about the math they share here regarding Alibaba at one point being a 4.5 times earnings stock. So that's not a multiple that I have arrived at when I looked at Alibaba. But Alibaba has certainly traded at a single digit free cash flow multiple times over the last 5 years. So there's that. As always, this is of course not a buy recommendation. Personally, I'm not super interested in Alibaba right now. I think there are better opportunities or equally attractive opportunities out there in more democratic markets. Let me put it this way. So obviously no investment advice, but I would of course be curious about what you think when it comes to Chinese equities. Are you interested in them, looking at them at all? Or is that an area where you're just like, no, not going to touch any Chinese equities? Take care.